OC Financial Media presents, in association with CHL Mortgage, as heard on KTLK AM1150, from LA to Orange County.
Your host, Dino Katsiametis.
It's about your real estate. It's about your money. From your estate to real estate, it's Money Matters with Dino.
Welcome back to Money Matters with Dino. If you have any questions for myself or my guests, pick up a pen, write this number down, and give us a call. It's 949-720-1616. That's 949-720-1616. Or you can check us out online at moneymatterswithdino.com. From your estate to real estate, we're here to help. This segment is brought to you by Reverse Mortgage Educators, and I want to just take a quick moment to talk about these guys because they've been on the show a few times now, and they've educated me. Even though I'm in the lending business, I really didn't know enough about these reverse mortgages. And I got to say, now that I've done my research and I've been educated on them, I do believe in them. You have to pick the right company to work with, but they are government sponsored and they're not there to take advantage of you like a lot of people think. There's a lot of checks and balances. And the reason why I like them is because I'm sick and tired of seeing the elderly live in poverty, something that they've been working their entire lives, raising children, paying bills, doing everything the right way. And at the end of the day, it seems like a lot of them would rather give their last dime to their child or grandchild and in essence, live in poverty of their own. And I don't like that. It's not needed in your last years of your life. So if you're 62 years or older, or you are younger and have family members that are of age and they're having a hard time meeting their bills, please take a moment to call Reverse Mortgage Educators and get educated because there are solutions. You can call us direct at 949-720-1616, and I'm going to personally be in touch with you guys and then get you in touch with the right person over there. All right. And also, before we get started, we're doing this new thing on Money Matters with Dino. If you want to check out the value of your home, text the word appraisal and your address to 313131. That's text the word appraisal and your address to 313131, and I'm going to have one of my trusted advisors get back to you guys within a 24 to 48 hour period. All right, so today we have a great topic, and it's at the right time because for a lot of you that don't know, starting January, there's a lot of new laws taking effect in the lending industry. We've all heard about the big crash that happened, and the DoddFrank Act, which changed the way lending is being done today. And really, what's happening now is they're starting to enforce it, and these changes are going to be significant, and they're going to affect you one way or another. So we brought on our specialists today. Our panel of experts are Joel Incorvaia. Gosh, and I'm having a hard time with that, but I think I said it right.
I think you're getting very close.
All right. He's our real estate expert who has done a lot of research in this field. And we have Fred Sed from Keller Williams, who's our real estate expert. Again, our topic is pain or pleasure. How will the new mortgage laws affect you? Guys, welcome to the show.
Thank you.
Thank you.
Joel, let's start with you. You're an attorney. You've done I don't know if you've read all 2,000 pages of this DoddFrank Act, but you've done a lot of research on it.
Like most lawyers, I have not read the entire 2,000 pages. And probably like most members of Congress, I have not done that either. But what I have done is read 400-page summaries of it and all aspects of it. And I have worked with mortgage lenders my entire legal career, which spans 33 years. So as part of my job, I have to give advice to them as to how to comply with the new laws. And so it's very important as part of what I do that I keep up to date with the changes, which is hard because these are the most comprehensive changes we've ever seen in government regulation of mortgage lending. And it's just a whole new landscape for everybody.
I'm curious, just I believe in America, one of the advantages we've always had is that the small businessman, the small company, is what's made us so great. But with these changes, is the small brokerage shop or the small bank, regional bank or whatever, are they going to be able to survive just due to all the new fees and for legal fees alone, and then all the new compliance departments and everything else that needs to be put in place?
I think it's going to be a lot more difficult, and we've already seen, I believe, a real consolidation in the financial lending industry. And because of the heavy regulation and the fact that it's going to cost a lot more to have people in your compliance department, legal people, other people involved in analyzing loans or going through the origination process, it's going to be a lot more difficult for smaller companies to survive. And we've already seen mortgage brokers who 8 years ago were doing about 60% of the loan originations in the United States almost be put out of business by DoddFrank and the changes that are occurring in regulation. And when the new rules go into effect in January, I think it will probably knock out almost the entire mortgage broker community because of the fact that a lot of the rules impose very severe restrictions on them that don't apply to other lenders. So I do see a consolidation. My big concern is 10 years from now, we'll have Wells Fargo, Bank of America, Chase Manhattan, and 3 or 4 other big lenders controlling the mortgage market, and that will stifle competition. And I think it's not really going to be beneficial to consumers.
Totally agreed with you. Well, thank you for being here today and sharing your insight with our listeners today. Mr. Fred Sed,
yes, sir.
Keller Williams,
What's
local
happening?
real estate expert and opinionated. From what I know,
Absolutely.
Has an opinion on everything.
Absolutely.
Thank you for joining us today.
Thank you for having me. I'm really excited to be here.
So tell us a little bit about your company and Keller Williams and the beliefs of Keller Williams and the area you specialize in.
Absolutely. Keller Williams is very well known. They're now the largest franchise real estate company in the United States with over 90,000 agents. So they're doing fantastic. And my specific location is actually in Irvine, in the middle of Orange County. We've got a great operation, great management, great ownership in that office, and we're growing every single day. But me specifically, I've been in this business 10 years. I'm a third-generation realtor. So my family goes back in residential real estate, mortgage development for over 80 years. So this is in my blood. So I've been opinionated since I got in 10 years ago by nature. But at least at this point in my career, 10 years later, I have facts and results to back it up.
And you have a YouTube channel of your own.
Right.
What's it called?
It's actually, the show that I have is every single Friday we have a 2 to 3 minute educational Fridays with Fred.
Fridays with Fred.
But all you got to do is go to YouTube and say Fred Sed.
Yep.
And you'll pull up all the videos that we've done, hundreds and hundreds, on topics to educate the public about real estate in every way, shape, or form.
Well, I like your style. One day a week, baby.
Now, 1 day a week, consistent.
Fridays with Fred.
Never miss it, baby.
All right. Well, guys, thanks again for coming. Let's get started with these questions and figure out what the heck is going on here and how these changes are going to affect you listening right now. So let's start with a little history. The mortgage meltdown in 2007 really affected a lot of people. And then in 2010, the DoddFrank Act was passed. Generally speaking, what is the DoddFrank Act? And let me, Joel, why don't you answer this?
Well, what it is a 2,000-page bill that comprehensively changes the way the government regulates the financial services industry, not just mortgage lending, but also Wall Street and securitization of mortgages and hedge funds and a whole bunch of different areas of financial services that needed reform. But one of the most significant things DoddFrank did is impose a very, very complex and stringent regulation of the mortgage lending industry that didn't exist before. Because honestly, before DoddFrank.
That's okay. You can call them names if you want.
I know. Before DoddFrank was enacted, most of the laws were directed towards giving consumers information so they could make an intelligent choice about the loans they were getting. For example, Truth in Lending said to the lender, tell the borrower up front exactly what the costs are going to be. And then the borrower can choose what is the best loan based on the disclosure of what the cost would be. We have a statute called RESPA that says the same thing. A lender, has to give the borrower an estimate of all the fees the borrower is going to pay when the loan closes. So the borrower can make an intelligent decision. And I think the basis of the law was basically that the consumer had the intelligence to make a decision as to what the best loan product would be for that consumer. Really what DoddFrank has done is said this: we don't trust the consumer to make that decision now. Now it's up to the lender to guarantee and to ensure that the borrower really qualifies for the loan that the borrower was seeking. And so it's kind of shifted this burden now onto the lender to ensure that the borrower has an ability to repay the loan. And that's something that never existed before. And so now the lender has to take numerous steps in the loan origination process to make sure that this borrower really is qualified to get this loan and has a very high probability of repaying it. So that really changes the landscape significantly, and it makes the loan origination process a lot more complex and I think a lot more difficult for lenders.
Yeah,
Now,
coming from the lending background is obviously what I do. In my opinion, what's happened is it's become so confusing that the lenders are having to spend so much money in order to try and learn or just figure out what the true definition is of the law. And there's nobody really to I guess plain and simple say what it is. So it's up to everybody to determine what it is on their own. And the amount of money that's being spent doing this, I believe, is causing the interest rates to be higher than what they should be. Because in reality, they're having to build in so much in order to pay for what's going on. Would you say that's accurate?
I think there's definitely going to be a cost to consumers because of the stringent requirements that have to be followed by lenders to make loans under the new regulations and the new law. And ultimately, somebody's going to have to pay those costs. Lenders really don't make, as you know, being in the business, the margins for profit are actually very small in the lending business. You have to make a lot of loans in order to make a good living in this business. And so when your cost of making loans goes up, you have to hire more compliance people, you have to have more processors and underwriters, you have to get more legal people involved, you have to comply with all these new rules and regulations. That makes the cost of the loan more expensive. And ultimately, I believe the consumers end up paying. And it's kind of what I call the boomerang effect. The government sees a problem, and there certainly was a huge problem with lenders making bad loans and being able to basically securitize and sell those loans to investors on Wall Street. And corrections had to be made. But as you said earlier, I think what's happened is the pendulum has kind of swung the other way, where now we're so concerned that every loan has to be perfect, that every borrower has to be perfectly qualified, that we've made it difficult for lenders to make loans to people that really deserve them and also do it in a cost-effective manner.
Yeah. It's difficult because I talk to so many people every day looking to get loans, and I have one in particular right now where they have a $1.5 million plus home, totally paid off. They have another rental property that's less than 50% loan to value. Their tax returns are about 150 pages. They have several businesses. They have plenty of money, and they're trying to buy this new investment property down in Laguna. And believe it or not, they're putting down 40%, and I'm having one heck of a time getting them approved. And it's just, I felt sorry for them. The poor lady said to me, she's like, the funny part is we're probably the most unlikely of everybody to ever default. It's just not what we do. And if you look at their credit report and you look at their scores and just everything they've done over the period of their life, it just doesn't seem feasible that I can't get them a loan. And it's very unfortunate that we've gotten all the way to this level. Now, I get some of the stuff, and I get that, if you're not putting any money down and there's no stated income, for example, or just options, then you don't deserve options if you don't have good credit and you don't have any money, and you don't have all this other stuff that's required. But if you have 90% of them, but you're say at a 48% or even 50% debt ratio instead of a 45, gosh, it just seems like there should be a way to make that work.
Right, and one of the problems we're seeing, and particularly with the new rule we call the QM rule, the qualified mortgage rule that goes into effect in January, is that the government, in effect, is standardizing loans and saying, here's a narrow range of loans that we're going to allow you to make. And these loans are going to require that you verify employment, you have to verify their income, you have to get a full appraisal on the property, you have to verify all their assets, just about every aspect of their financial picture. And you can't make a loan to this person and sell it to Fannie Mae or Freddie Mac or at FHA or VA unless you ensure that their debt-to-income ratio does not exceed 43%. And we know just statistically that there's probably 10 to 20% of the people out there today, consumers, who today would qualify for financing under the current underwriting rules used by most lenders, who now will not qualify.
Hold that thought, because you said a number that was important that a lot of people don't know about that I want to explore a little bit more. But we're getting the stink eye from Phil over here, so we got to break for a quick commercial. You're listening to Money Matters with Dino, and we can be heard every weekend afternoon. If you missed any part of the show, you can always check us out online at moneymatterswithdino.com. And write this number down and keep it, because we're always here for you if you have any questions. Our phone number is 949-720-1616. That's 949-720-1616. We'll be right back after the break.
"50 years ago, you didn't have any worries. You danced the night away. But the music slowed down. And now you have financial worries and woes you never thought you would be faced with in retirement.
I'm so afraid that my husband and I aren't going to be able to afford to live in our home.
Thousands of people have chosen to put a spring in their financial step by taking advantage of a government-insured reverse mortgage loan that turns the equity in your home into tax-free cash. You can use the cash for whatever you want. Pay off medical bills, credit cards, travel, and start to enjoy your retirement. Best of all, you still own your own home. Call now. Find out how you can qualify for a life without monthly mortgage payments. Call now, and we will send you a free DVD that will explain if a reverse mortgage is right for you. Call the number on your screen right now. No obligation, just education.
Mortgage professionals, are you looking for a company that values you as a loan officer? One that can provide you with the tools you need to grow your business at your pace? Then look no further than CHL Mortgage. CHL Mortgage provides you with a full range of residential loan products and services. You'll be backed by an exceptionally trained team of professionals that can take your clients as seriously as you do. Your clients will be treated with dedicated service, personal integrity, and exceptional professionalism. You'll be able to guide them in the right loan with competitive rates and keep them on the road to achieving life's goals. To get started on advancing your career, call Dino with CHL Mortgage at 949-720-1616. That's CHL Mortgage, 949-720-1616.
Welcome back to Money Matters with Dino. We can be heard every weekend afternoon. And if you missed any part of the show, you can just check us out online at moneymatterswithdino.com, or you can go to our YouTube channel, Power Players Radio, and you can plug in either Power Players Radio or Money Matters with Dino, or heck, just my name, if you can even say my last name or spell it for that matter. And that's Katsiametis for anybody that thinks they can give it a shot. Anyways, all our shows from the past are there. It's a very content-rich show. Our goal here is to always educate you on anything that has to do with money. That's why we always say, from your estate to real estate, Money Matters with Dino. This next segment is brought to you by Citywide Home Loans. Citywide Home Loans is a mortgage company that I work for, and that I have a branch down in Newport Beach, but we're located throughout the nation. And it's one of these companies that really, truly does care about you. We are not one that does all this advertising on billboards and TV and radio and all that good stuff. We are more interested in finding out the solution that best suits your needs. So for the real deal, right, you want to know exactly what's best for you, not what somebody's telling you because they think that's what you want to hear. Give us a call at 949-720-1616. That's 949-720-1616. We'll go over all the options that best suit you and your family. All right, before we get going back into our discussion, I also want to introduce the appraisal deal that we have going on here at Money Matters with Dino. If you do any kind of text messaging, it's really simple. All you gotta do is text the word appraisal and your address to 313131, and I'm gonna have one of my trusted advisors get back to you within a 24 to 48 hour period. It's text the word appraisal and your address to 313131, and we'll get somebody on it right away to give you the true accurate value of your home, not a silly algorithm that that Zillow and Redfin and all these other people use to give you more of a generic feel. We want to know the upgrades you've done in your house, the lot size, the view, all these various things that'll give you the real value. All right. Before we broke on the last commercial, we were talking about pain or pleasure and how the new mortgage laws will affect you. And Joel threw out a number of 43%. We were talking about qualifying debt ratios and stuff like that. Right now, the majority of the loans out there are 45%. If you can be a 45% or lower debt ratio, you can typically qualify, assuming you meet all of the other qualifications. But Joel, you said 43% a second ago, and I know starting January, that's going to be the new number. Is that correct?
That's correct under the new QM rules. And that doesn't mean that every loan has to be at 43%, but to get what we call safe harbor protection, protect lenders from lawsuits from borrowers, and to have loans that the government agencies will actually buy, you have to stick to the 43%. So that's a significant change.
So even though I'm in the industry, I'm still learning as we go. So if you don't mind, I'd like to just ask some questions just for my own general knowledge. What if you have a scenario like I was just talking about where the person has credit, has strong financials, has assets in other homes and various things like that, and they're at a higher debt ratio? Will a bank, I should say, give a loan to a person like that based on all of the other determinations, all the other factors, or will they cut it basically?
They might make a loan, but they're not going to make a loan that they can sell to Fannie Mae or Freddie Mac. And we have to understand that right now about 95 to 97% of all loans being made in the United States today are being sold to those now government agencies. So you have to basically get a bank or a lender to decide that either that loan could be sold to private sources or kept in-house as a portfolio loan. So there might be a lender out there willing to do that, but that lender will now probably want a higher interest rate because the lender's taking on greater risk. The lender has to hold the loan or has to sell it to somebody else who probably wants more of a profit based on the risk inherent in the loan. And another problem is, see, if that loan does not meet that 43% debt-to-income ratio, it no longer has what we call safe harbor protection. So the borrower can come back later and say, you know what, I wasn't really qualified for that loan. You missed something. You didn't know that I just lost my job. You didn't know that I just took $30,000 on my bank account, and that should have been counted. And the truth is, I didn't qualify. And one of the things that DoddFrank does that had never been done before is it gave the consumer the right to actually sue the lender because the lender did not properly qualify the borrower. So the borrower comes back now and can say, after the fact, maybe years after the fact, I didn't really qualify for that loan, so I'm going to sue you for my damages because now I lost my property in foreclosure or I lost my equity in the home. And so that creates great risk that was not there before for lenders. And how do we assume risk? We pay for it.
So I'm not going to make any stupid lawyer jokes, but so who wins here? Sounds to me like the lawyers always win.
I think there's going to be a lot of very busy attorneys because of what's going on here. There's a lot of very busy lawyers trying to explain to lender clients what the new law means. Yep. But I think what's going to happen in a couple of years is some of these very intelligent, what we call plaintiffs lawyers or consumer lawyers, are going to realize that there's basically a gold mine of litigation here.
Sure.
Because the law is so ambiguous as to what it means to determine the borrower's ability to repay. So I think there will be a lot of litigation. Maybe not right now, but I think starting in 1, 2, 3 years from now, there will be many, many new lawsuits filed over this whole issue of of ability to repay and what a qualified mortgage
Can
is.
something like this get unraveled in 3 years if they realize it's really killing the lending industry as a whole?
I think that the government has the ability to make some changes. There's a new super government agency, I call it, called the Consumer Finance Protection Bureau, CFPB, that was created through DoddFrank to basically be kind of a consumer watchdog agency to really protect consumers and to make sure that the laws were enforced. Now, it has some discretion in terms of how it makes these regulations, but my experience with those people is that most of them don't really know much about mortgage lending. They didn't come out of a mortgage lending background. They don't understand the business, and they're coming up with regulations that they think will help the consumer, but it'll be years before they realize that it's really going to backfire. Maybe at that point there might be changes made, but the government takes a long time, as you know, to change the law and to do things to kind of bring things back into balance.
So, Fred, let me bring you in here for a minute. In the real estate industry, I mean, you're out there, you're on the streets every day. You're talking to consumers. You're doing the day-to-day transactions. How do you think all of these changes are going to affect the real estate market?
It's a great question. I think in the short run, in let's say the beginning of 2014, the main thing that both of you had mentioned, especially with Joel and the regulations, is that less people will qualify to buy a home. So my immediate reaction is the individuals out there that are thinking about buying a home in the near future that are going to put a low down payment, that might have some debt, they're on that borderline as it is. So when they reduce that debt to income ratio from 45 to 43, that can fully knock them out of the market. So that's why I've been pushing so hard with our clientele that if you're serious about buying a home right now, in the near future, within 6 months, do it now towards the end of 2013, because you potentially won't be able to come January 1st, 2014. So that's a big concern for me, who deals with buyers on a daily basis in Orange County.
Yeah, I think it's great advice, because I can honestly tell you that all the loans that I do on the purchase transactions, when people are out there shopping, they come to me first and say we need to get pre-qualified, and they never buy something when they have a 38% debt ratio. It's always 43, 44, 45%. I mean, they take it to the max because they always want to get the best home they possibly can for what they make.
Mm-hmm. Agreed.
So that scares me a little bit as well. All right, well, so let's break it down again a little bit. We have the creation of the CFPB, which is the super agency, as you call them, and I know that they police banks primarily. Do they have authority over any other industries?
Well, their goal basically is to police everybody involved in loan origination. So not just banks, but what you call private mortgage bankers. A broker, anybody that originates loans is governed by the new rules. And they enforce not only the Truth in Lending Act, Dodd-Frank, but also what we call the Real Estate Settlement Procedures Act, which is another federal law that governs real estate loans and consumer disclosure. So what we're seeing with them is a very much a pro-enforcement mentality in terms of going after lenders, loan originators that they think are not complying with the law. Where before you didn't see that many prosecutions, already they've gone after some pretty large lenders and tried to levy large fines for violating these new rules.
Well, here we go again. Phil's giving us that signal. All right. This segment was brought to you by Citywide Home Loans. And don't go anywhere, though, because we're just getting into the real meat and potatoes of this stuff. If you have any questions, take this number down and give us a call. It's 949-720-1616. That's 949-720-1616. I want you to remember that I actually answer these calls personally. So if it goes to voicemail, please leave your information. I will give you a call back personally, okay? That's 949-720-1616, or you can check us out online at moneymatterswithdino.com. We'll be right back after the break.